The information presented in this video and accompanying materials is strictly for educational and informational purposes only and does not constitute financial, legal, or professional advice. The automotive market, auto loan interest rates, and individual credit lending criteria are subject to constant fluctuation based on macroeconomic conditions and individual financial profiles. The case studies, historical trends, and potential outcomes discussed herein are based on generalized market observations and public data, and they should not be interpreted as definitive predictions or personal recommendations. Viewers must understand that taking on debt carries inherent risks, and individual results will vary significantly based on personal credit history, income, down payments, and the specific terms negotiated with lenders. We strongly advise all viewers to conduct their own independent due diligence, carefully review all financing disclosures, and consult with a certified financial planner, attorney, or qualified fiduciary before making any major financial decisions or signing any binding auto loan agreements. Do not make financial decisions based solely on the contents of this presentation. Right now, an invisible financial crisis is quietly destroying the wealth of the American middle class, and it is parked right in your driveway. As we look at the current economic landscape, total auto loan debt in the United States has violently surged past the staggering mark of $1.6 trillion. To put that massive figure into perspective, it means millions of Americans are currently driving vehicles they mathematically cannot afford, trapped in loan agreements designed to slowly drain their net worth over the next 7 years. We are seeing average monthly payments for new vehicles shatter historical trends, frequently crossing the $1,000 threshold, while average loan terms are being dangerously stretched to 72, 84, and in some extreme case studies, even 96 months. This is not just a statistical anomaly. It is a systematic wealth extraction machine operating in plain sight, fueled by a deeply entrenched system of public misinformation. You have likely been conditioned to believe a very specific set of rules about buying and financing cars. You have been taught these rules by family members, society, and most effectively, by the massive marketing arms of the automotive industry itself. But what if the very strategies you believe are protecting your wallet are actually the exact mechanisms being used to empty it? Consider a common scenario that unfolds thousands of times a day across the country. Let us look at a typical consumer walking into a dealership on a Saturday afternoon. They have done their preliminary research. They know the exact make, model, and trim level they want. They have even looked up the invoice price and feel prepared to negotiate fiercely on the sticker price of the vehicle. They spend hours battling with the salesperson, refusing the initial offers, and finally, after much back and forth, they get the price of the car dropped by $2,000. They feel a massive rush of victory. They believe they have beaten the system. But this is exactly where the illusion takes hold, because the real transaction has not even begun. The moment that triumphant buyer is escorted into the finance and insurance office, the small windowless room at the back of the dealership, the entire game changes. The finance manager is not there to simply process paperwork. They are highly trained professionals utilizing complex psychological tactics and sophisticated mathematical structures designed to maximize the dealership's profit on the financing itself. While the buyer is fixated on that $2,000 discount they just fought so hard for, the finance manager is manipulating the interest rate, extending the term length, and weaving in overpriced warranties and gap insurance, effectively packing thousands of dollars in hidden costs into the back end of the loan. This happens constantly because Americans fundamentally misunderstand how auto financing truly functions. We treat cars as emotional purchases rather than depreciating financial liabilities, and we rely on outdated advice that no longer applies to the modern lending environment. You might think that securing financing through the dealership is always the most convenient and cost-effective route, or that a lower monthly payment automatically equates to a better financial deal. You might firmly believe that putting zero money down is a smart way to leverage your cash, or that leasing is universally a waste of money compared to buying. These are not just innocent misunderstandings. They are highly expensive misconceptions. In fact, there are 5 specific, deeply ingrained myths about car loans that are actively keeping the American public trapped in a relentless cycle of negative equity. Negative equity, commonly known as being upside down or underwater on your loan, occurs when you owe the bank more money than the vehicle is actually worth in the open market. And right now, a terrifying percentage of trade-ins involve negative equity, forcing buyers to roll their old debt into their new car loans, creating a compounding snowball of debt that becomes mathematically paralyzing and nearly impossible to escape without severe financial loss. In this comprehensive deep dive, we are going to meticulously dismantle these 5 common car loan myths piece by piece. We are going to expose the underlying realities behind these dangerous misconceptions so that you can navigate the automotive market with clarity and confidence. Pay incredibly close attention, because while the first two myths might force you to reconsider everything you thought you knew about your credit score and dealership financing, it is myth number 3 that is entirely responsible for the negative equity trap, devastating millions of households. Furthermore, myth number 5 involves a closely guarded industry practice regarding how interest rates can be legally marked up without your explicit knowledge. A practice that, once understood, can potentially keep thousands of your hard-earned dollars from vanishing into a lender's pocket. The ultimate goal of this analysis is to equip you with institutional-grade financial literacy. By the time we are finished, you will possess a profound understanding of auto financing mechanics that rivals the knowledge of the people sitting across the desk from you at the dealership. This is about leveling the playing field. It is about transforming you from a passive, vulnerable consumer into an empowered, highly educated buyer who understands exactly how to negotiate the total cost of ownership, rather than just fixating on an artificially manipulated monthly payment. We are going to thoroughly explore historical trends in automotive lending, analyze detailed mathematical case studies of optimal versus predatory loans, and provide you with a rigorous step-by-step framework to evaluate any auto financing offer you receive in the real world. You will learn exactly how to analyze loan amortization schedules, how to calculate the true cost of an extended loan term, and how to separate the actual price of the vehicle from the complex web of financial products frequently sold alongside it. If you are planning to buy a car in the near future, currently paying off an auto loan, or simply want to protect your long-term financial health, mastering this information is not just an option. It is an absolute necessity for economic survival in today's market. The financial landscape is incredibly unforgiving to those who do not understand its rules, but for those who do, it offers the opportunity to build and protect lasting wealth. Let us begin dismantling these costly illusions, starting with the single most pervasive lie Americans are told about securing a car loan. Myth number 1 is the deeply ingrained belief that the dealership acts as your personal financial broker, shopping your credit profile around to dozens of banks specifically to secure the lowest possible interest rate on your behalf. This is a fundamental misunderstanding of the automotive business model. To understand why this is a myth, we must examine the hidden architecture of automotive financing and expose a highly lucrative industry mechanism known as the dealer reserve. When you sit down at the dealership and hand over your personal information to run a credit check, you operate under the assumption that the finance manager is using their vast network of lenders to find a loan that benefits your wallet. In reality, the dealership is a highly sophisticated middleman. They are not lending you their own money. Instead, they submit your credit application to their network of partner banks, credit unions, and captive lenders, which are the financial arms of the car manufacturers themselves. These financial institutions review your credit history, your income, and the risk associated with the specific vehicle you are purchasing. Based on their risk assessment models, the bank will then send the dealership a wholesale interest rate. In the automotive industry, this wholesale number is referred to as the buy rate. This is the actual interest rate that you, the consumer, have mathematically qualified for based on your unique financial profile. However, this buy rate is almost never the interest rate that is presented to you on your final lending contract. This brings us to the core of the deception. Automotive lenders legally allow dealerships to artificially inflate the buy rate before presenting the loan terms to the customer. This markup is the dealer reserve, and it represents a massive profit center for the dealership. When the finance manager slides the contract across the desk, the rate you see is the retail rate, which includes this hidden markup. The bank and the dealership then split the profit generated by this additional, unnecessary interest you will be paying over the life of the loan. To illustrate the devastating financial impact of this practice, let us examine a specific case study set in our current year of 2026. Imagine a consumer named Michael. Michael is a responsible professional living in the United States, and he has worked diligently for years to build an excellent credit score of 780. He needs a reliable mid-size sport utility vehicle for his family, and he finds the perfect model priced at $40,000. Because Michael believes the myth that the dealership will automatically reward his excellent credit with the best possible rate, he walks into the finance office completely unarmed. The finance manager submits Michael's pristine credit profile to a major national bank. The bank instantly approves Michael at a buy rate of 6% based on historical trends for top-tier borrowers. However, the finance manager, looking to maximize the profitability of the transaction, legally marks up that interest rate by 2 full percentage points. When Michael reviews his paperwork, he is offered an interest rate of 8%. Because 8% might align with general advertisements he has seen recently, and because the finance manager assures him this is a highly competitive rate for the current 2026 market environment, Michael signs the contract for a 72-month term. He drives away feeling satisfied, completely unaware of the invisible wealth extraction that has just taken place. Let us meticulously break down the mathematics of what just happened to Michael and examine the potential outcomes of this single signature. If he had been given his actual approved by rate of 6% on that $40,000 loan over 72 months, his total interest paid over the life of the loan would be approximately $7,600. But because he signed the contract at the marked-up retail rate of 8%, his total interest skyrockets to over $10,500. By simply manipulating a few numbers on a screen, the dealership extracted nearly $3,000 of pure, hidden profit directly from Michael's future wealth. This is $3,000 that Michael must now earn, pay income tax on, and then surrender to a bank, all for absolutely zero additional value to his vehicle. Imagine if you were buying a house and your real estate agent secretly tacked on an extra 2% to your mortgage interest rate just for printing the closing documents, keeping the massive difference as an undisclosed commission. The public would be completely outraged, and regulatory agencies would immediately intervene. Yet, in the automotive industry, this exact mechanism is standard operating procedure, carefully protected by complex legal frameworks and intense industry lobbying. Consumers are losing billions of dollars annually to this single mechanism, primarily because they falsely equate convenience with financial optimization. The convenience of handling all the paperwork in one room is precisely the bait used to execute this expensive maneuver. The most effective method to protect yourself from the dealer reserve trap is a strict strategy of proactive pre-approval. Before you ever set foot on a dealership lot, you must independently secure an auto loan pre-approval from a local credit union, your primary bank, or an online automotive lender. When you approach a lender directly, there is no middleman capable of marking up your buy rate. The rate you are offered by a direct lender is the actual retail rate you will pay. By walking into the dealership with an independent pre-approval in hand, you completely strip the finance manager of their hidden leverage. You transform yourself from a dependent borrower into a highly empowered cash buyer. At that point, you can challenge the dealership to beat your pre-approved rate. If their partner lenders can genuinely offer a lower buy rate, and the dealer is willing to process the loan without a massive markup to secure the sale, you can choose to accept their financing, effectively forcing them to compete for your business rather than monopolizing it. By understanding the buy rate versus the contract rate, you instantly shield yourself from one of the most common and expensive traps in the automotive world. You take control of the financing narrative and ensure that the interest you pay accurately reflects your actual creditworthiness, rather than the dealership's monthly profit targets. However, protecting your interest rate is only the first layer of defense in a much larger financial battlefield. Many consumers who successfully secure a low interest rate still end up making catastrophic financial errors because they fundamentally misunderstand how lenders view their credit history. You might assume that having a pristine credit score like Michael ensures you are completely immune to predatory lending structures. You might firmly believe that a high 3-digit number next to your name serves as an impenetrable shield against financial hardship. But what if the data shows that having a top-tier credit score actually makes you a highly desirable target for a completely different, far more dangerous type of mathematical trap, one that specifically weaponizes your good financial behavior against you to keep you trapped in debt for a decade? This brings us directly to the second massive misconception dominating the 2026 automotive market. Myth number 2 is the incredibly dangerous assumption that an excellent credit score is an absolute shield against toxic loan structures, and therefore, if a bank approves you for a massive loan with a low monthly payment, it must be a financially sound decision. We have been culturally conditioned to view loan approval as a badge of honor, a validation of our financial responsibility. But lenders do not view your 800 credit score as a reason to give you a discount. They view it as a statistically safe opportunity to extract maximum yield over the longest possible time horizon. They know that prime borrowers are mathematically less likely to default, which makes you the perfect candidate for the most insidious financial product currently flooding the market, the ultra-extended auto loan. Historical trends over the past 5 years show a dramatic shift away from the traditional 48 or 60-month terms. Today, dealerships are aggressively pushing 72, 84, and now even 96-month loan terms onto their most qualified buyers. They weaponize your pristine credit history to justify extending your debt timeline, masking the devastating long-term costs behind the illusion of an affordable monthly payment. To understand how this trap functions, you must understand the mathematical relationship between loan amortization and automotive depreciation. Vehicles are depreciating liabilities. The moment you drive a new car off the dealership lot, it experiences an immediate and severe drop in value, often losing up to 20% of its purchase price in the first year alone. When you finance a vehicle over a traditional 48-month term, your monthly payments are large enough that a significant portion of your money goes toward reducing the principal balance, allowing you to build equity and outpace that rapid depreciation. However, when you stretch that exact same loan over 84 or 96 months, the internal mathematics completely invert. Because the term is so long, the amortization schedule dictates that the vast majority of your payments during the first 3 to 4 years go almost entirely toward paying the interest, barely making a dent in the principal balance of the vehicle itself. This creates a massive widening gap between what you owe the bank and what the vehicle is actually worth on the open market. Let us examine a highly realistic case study to illustrate this mechanism. Meet Sarah, a medical professional in the United States navigating the 2026 auto market. Sarah has an exceptional credit score of 815. She decides to purchase a luxury sport utility vehicle with a total out-the-door price of $60,000. She plans to put $0 down because she believes she can leverage her excellent credit to keep her cash in the bank. When she sits in the finance office, the manager praises her financial responsibility and presents her with an alluring offer: a 96-month loan at a seemingly reasonable interest rate of 6.5%. The finance manager highlights the manageable monthly payment of approximately $800, framing it as a reward for her years of disciplined credit management. Because Sarah is entirely focused on the monthly cash flow, rather than the total cost of ownership, she gladly signs the contract. She drives away feeling victorious, believing her high credit score just secured her an incredible deal on a premium vehicle. But let us dive deep into the mathematical reality of Sarah's potential outcomes over the next few years. For the first 36 months, Sarah faithfully makes her $800 payments, totaling nearly $29,000 out of pocket. She assumes she owns a significant portion of her vehicle. However, because of the 96-month amortization schedule, a massive portion of that $29,000 went straight to the lender as interest. Her principal balance has only decreased by a fraction of what she expects. Now, let us factor in the merciless reality of automotive depreciation. After 3 years, that $60,000 luxury vehicle has realistically lost roughly 40% of its value, based on historical market trends. The vehicle is now worth perhaps $36,000 on the open market. Yet, when Sarah looks at her loan statement, she discovers she still owes the bank over $42,000. Despite making every single payment perfectly on time for 3 years, and despite having a top-tier credit score, Sarah is now trapped in $6,000 of negative equity. She is completely underwater. Imagine if Sarah suddenly experiences a lifestyle change in year 4. Perhaps she decides to start a family and needs a different type of vehicle, or perhaps the maintenance costs on the luxury vehicle become unexpectedly burdensome. She takes the vehicle back to a dealership to trade it in. The appraiser offers her the current market value, but because her loan payoff is thousands of dollars higher than the appraisal, she cannot simply hand over the keys and walk away. To sell or trade that vehicle, she must physically write a check for $6,000 out of her own savings just to cover the negative equity gap, effectively paying the bank for the privilege of giving up her car. If she does not have that cash readily available, she is functionally a prisoner to that specific vehicle and that specific loan for another 4 to 5 years until the amortization curve finally crosses the depreciation curve. This is how the financial industry uses your good behavior against you. A subprime borrower with a poor credit score would never be approved for a $60,000, 96-month loan because the bank deems them too risky. But because Sarah proved she was reliable, the bank gladly extended the rope, knowing she would dutifully make the payments while remaining mathematically trapped in the asset. The 96-month loan is not a convenience. It is a meticulously engineered wealth destruction tool disguised as affordability. It transforms a depreciating piece of machinery into a decade-long financial anchor. And while understanding this amortization trap is crucial for protecting your net worth, what happens when a consumer like Sarah does not have the $6,000 in cash to cover that negative equity gap when she desperately needs to change vehicles? What happens when the dealership offers a seemingly magical solution to to simply make that negative equity disappear by structuring a brand new deal. This brings us to the absolute darkest corner of the automotive finance industry, a pervasive and catastrophic practice that is silently bankrupting the middle class. We are about to uncover myth number 3, the devastating illusion of the trade-in rollover, and expose exactly how dealerships legally bundle your old debts into your new loans, creating a compounding financial disaster that can completely destroy your financial future before you even realize what you have signed. Myth number 3 is the incredibly widespread and mathematically lethal belief that when a dealership advertises they will pay off your trade-in no matter what you owe, they are somehow absorbing your negative equity as a cost of doing business or extending a financial favor to earn your loyalty. You have likely heard the relentless radio and television commercials across the United States proudly declaring this exact phrase. It sounds like a miraculous escape hatch. It sounds like a clean slate. For a consumer trapped in an upside-down loan, walking onto a dealership lot and hearing a sales manager say those magic words feels like throwing off a heavy chain. But the harsh, undeniable reality of auto finance is that dealerships are not charities, and negative equity never simply vanishes. It does not evaporate. Instead, it is meticulously and legally transferred, completely reshaping the risk profile of your brand new auto loan through a process known in the industry as carrying over or rolling negative equity. To comprehend the sheer magnitude of wealth destruction occurring here, we must dissect the precise mechanics of a negative equity rollover. When you owe more on your current vehicle than its actual market value, that difference is unsecured debt. Let us look closely at a detailed case study set right now in our current year of 2026 to see exactly how this trap springs shut. Meet David, a hardworking teacher living in the Midwest. 4 years ago, David purchased a sedan. Due to a combination of a high initial interest rate, a long loan term, and the rapid depreciation of that specific make and model, David currently owes $25,000 on his auto loan. However, when the dealership appraiser evaluates David's sedan today, historical trends and current market data dictate that its true wholesale trade-in value is only $18,000. This leaves David with exactly $7,000 of negative equity. He is $7,000 underwater. David needs a larger vehicle for his growing family and selects a reliable 2026 crossover sport utility vehicle with a sticker price of $38,000. He sits down with the sales professional, explains his situation regarding his current loan, and is immediately met with a reassuring smile. The salesperson confidently tells David not to worry, assuring him that the dealership will cut a check to his old bank, completely paying off the $25,000 balance and giving him a fresh start in the new crossover. David is thrilled. He signs the paperwork, focusing entirely on the fact that his old burdensome loan is now officially closed out. But here is the devastating mathematical reality, hidden within the fine print of his new contract. The dealership did indeed pay off David's old bank, but they took that $7,000 deficit and quietly stacked it directly on top of the purchase price of the new crossover. Let us trace the numbers step by step to reveal the true horror of this transaction. The new vehicle costs $38,000. The dealership adds the $7,000 of negative equity from the old sedan. Then they add the mandatory state sales taxes, the dealership documentation fees, and the title and registration costs, which let us conservatively estimate at $3,000. David's new starting loan principal is no longer $38,000. It has instantly ballooned to an astonishing $48,000. He is financing $48,000 for a vehicle that is only worth $38,000 the second he signs the paper. But the financial bleeding does not stop there. Because David rolled his old debt into a brand new loan, he is now paying interest on that $7,000 of negative equity all over again, but this time at the interest rate of his new loan and stretched out over a brand new term length, perhaps another 72 months. He is actively paying compound interest on a vehicle he no longer even possesses. Imagine if you went to a restaurant, ordered a meal, could not finish paying for it, and the restaurant simply added your outstanding balance to your grocery bill for the next 6 years, charging you interest on the food you ate half a decade ago. That is exactly what a negative equity rollover is, applied to one of the most expensive purchases of your life. If we look at historical trends in automotive lending leading up to 2026, we see a terrifying pattern emerging across the United States. Consumers are treating vehicles like disposable smartphones, trading them in every 2 or 3 years before they have built a single dollar of actual equity. They roll $3,000 of negative equity into their second car. A few years later, they roll $6,000 into their third car. This creates a compounding snowball of phantom debt. It is entirely possible and increasingly common to find borrowers driving a modest $30,000 vehicle while carrying a legally binding loan balance of $50,000 or more. They are functionally trapped on a treadmill of debt, completely immobilized by previous financial decisions that have been bundled and securitized by the automotive lending industry. When you understand this mechanism, you begin to see why dealerships are so eager to take your upside-down trade-in. They are not doing you a favor. They are securing a vastly larger loan amount upon which they can generate higher commissions, larger dealer reserve markups, and deeper financial entanglement. The bank taking on this new, massively inflated loan is also acutely aware of the risk. They recognize that David's loan-to-value ratio is dangerously high. He is financing 126% of the vehicle's actual value. In traditional finance, a bank would instantly reject an uncollateralized loan of this magnitude, because if David defaults the next day, the bank cannot recoup its money by simply repossessing the car. The math simply does not work in the bank's favor on the surface. So how exactly does the dealership convince massive, risk-averse financial institutions to approve these wildly inflated, negative equity-stuffed loans day after day? Why would a bank willingly lend $48,000 against an asset strictly valued at $38,000? The answer lies in the highly lucrative, heavily pushed financial products sold in the back office, specifically designed to bridge this massive risk gap while extracting even more wealth from the consumer. And this leads us directly to myth number 4. A misconception surrounding the concept of zero down payments and the true, hidden cost of dealership add-ons that fundamentally change the entire architecture of modern auto loans. Once you see how these back-end products are weaponized to facilitate bad debt, you will never view a car dealership the exact same way again. Myth number 4 is the dangerous illusion that securing a vehicle with absolutely $0 down is a sophisticated financial strategy, and that the accompanying financial products sold in the back office are reasonably priced safety nets required to protect your investment. In our modern economic landscape, you will frequently hear well-intentioned but fundamentally flawed advice suggesting that you should always keep your cash in the bank, leverage the lender's money, and drive away without writing a check. Consumers believe that if a bank is willing to front 100% of the capital, they have successfully gamed the system. However, this perfectly sets the stage for the most profitable maneuver a dealership can execute. When you contribute zero capital toward the purchase of a depreciating asset, you instantly trigger a cascading mathematical crisis related to a metric called the loan-to-value ratio. The loan-to-value ratio is the exact percentage of the loan amount compared to the true wholesale value of the vehicle. Financial institutions strictly monitor this ratio because it dictates their total risk exposure. If you purchase a vehicle for $40,000 with zero money down, your loan does not simply start at $40,000. You must immediately add state sales taxes, registration fees, and mandatory dealership documentation charges, which can easily add another $3,000 to $4,000 to the total balance. Before you have even received the keys, your loan amount is $44,000. The moment you drive that vehicle over the curb and onto the public street, historical trends dictate it instantly transitions from a new vehicle to a used vehicle, suffering an immediate depreciation hit of approximately 10%. The vehicle is now realistically worth $36,000 on the open market, but your legally binding loan balance is $44,000. Your loan-to-value ratio has just violently spiked to over 122%. You are financing 22% more than the physical collateral is actually worth. Traditional banking principles state that a loan this top-heavy is incredibly risky. If you were to default the following week, the bank could not repossess and sell the car to recover their money. They would be completely exposed to an $8,000 loss. So how does the dealership convince a conservative financial institution to fund a loan that is mathematically destined for negative equity from day one? They utilize highly engineered, massively marked up back-end products. To understand this, let us look at a highly realistic case study occurring in the year 2026. Meet Robert, an engineer living in the United States who decides to purchase a $50,000 pickup truck. Robert subscribes to the zero-down philosophy, wanting to keep his savings liquid. He negotiates fiercely on the price of the truck, feeling incredibly accomplished when he saves $1,000 on the sticker price. He is then escorted into the finance office, exhausted but victorious. The finance manager reviews Robert's zero-down structure and begins to skillfully implement the trap. The manager calmly explains that because Robert is putting no money down, he is immediately exposed to massive financial ruin if the truck is totaled in an accident or stolen. The manager explains that Robert's auto insurance company will only pay the actual cash value of the truck, which will be significantly less than his total loan balance. To solve this manufactured crisis, the finance manager introduces guaranteed asset protection, universally known as gap insurance. Gap insurance is designed to pay off the remaining loan balance if the vehicle is totaled and the primary auto insurance payout falls short. The manager frames this not as an option, but as a critical, almost mandatory piece of financial armor. Robert, suddenly terrified of owing $10,000 on a destroyed truck, agrees to purchase the gap policy for $1,200. Seeing that Robert is highly responsive to risk aversion, the finance manager then introduces a comprehensive extended warranty for $3,500, arguing that modern trucks have complex computer systems that cost thousands to repair. Finally, he adds an $800 tire and wheel protection package. Robert agrees to all of these additions, genuinely believing he is simply protecting his investment and being a responsible consumer. Let us carefully dissect the mathematical devastation of Robert's decision. The dealership did not just sell Robert a truck, they successfully sold him $5,500 of highly inflated financial paper. That gap insurance policy that Robert bought for $1,200 could likely have been added to his standard auto insurance policy for perhaps $40 a year, totaling less than $300 over the life of the loan. The dealership just made a massive commission on the markup. But the true wealth destruction happens because Robert did not pay cash for these add-ons. He rolled them into his zero-down auto loan. His total loan balance is now approaching $60,000 on a truck that is only worth $45,000. Even worse, he is paying interest on all of those products. Over a 72-month term at a standard interest rate, Robert will pay hundreds of dollars in interest specifically on his gap insurance and his extended warranty. Imagine if you were purchasing a house, and the real estate agent convinced you that because you were putting very little money down, you had to buy a massively overpriced home warranty and a highly inflated life insurance policy directly from them, and then they permanently attached the cost of those policies to your 30-year mortgage balance so you were paying compound interest on them for decades. The public would immediately recognize this as a predatory financial structure. Yet, in the automotive industry, bundling these marked-up products into the principal balance of an already underwater loan is the standard mechanism used to secure bank approval for high-risk buyers. The bank approves the dangerously high loan-to-value ratio specifically because the gap insurance protects the bank from a total loss, and the extended warranty theoretically ensures the vehicle remains operational, so the borrower keeps making payments. The dealership reaps massive profits from the product markups, the bank secures a high-yield loan protected by the very products the consumer was forced to buy, and the consumer is left entirely trapped under a mountain of negative equity, paying interest on thin air. This toxic combination of zero down payments and inflated back-end products is precisely what creates the paralyzing cycle of debt that prevents Americans from building real wealth. But what happens when you carefully navigate all of these traps, secure a fair price, refuse the overpriced add-ons, sign a perfectly reasonable contract, and drive your new vehicle home to celebrate, only to receive a terrifying phone call from the dealership 3 days later? What happens when the finance manager tells you that your financing actually fell through, the bank rejected the contract you already signed, and you must return to the dealership immediately to sign a brand new agreement at a significantly higher interest rate, or they will report the vehicle as stolen? This brings us to myth number 5, an incredibly deceptive and fully legal industry tactic that weaponizes the very timing of your credit approval to extract thousands of dollars from you after the deal is completely done. Myth number 5 is the widely held belief that once you sign the financing contract and drive the vehicle off the dealership lot, the deal is legally finalized and the interest rate on your paperwork is set in stone. This misconception leads thousands of Americans every year into a psychological and financial trap known as spot delivery, or more aggressively, as the yo-yo scam. To understand how this functions in the current 2026 automotive market, we have to look at the gap between the moment you sign a contract and the moment a bank actually buys that contract from the dealership. In many states across the United States, dealerships are legally allowed to engage in what is called conditional delivery. This means they allow you to take possession of the vehicle based on the condition that they can find a lender to accept the terms of the loan they just wrote for you. Imagine if you went to a high-end electronics store to buy a $5,000 home theater system. You sign a financing agreement for a fixed monthly payment, you take the system home, you mount it on your wall, and you start enjoying it. Then, for days later, the store manager calls you and says that the finance company actually rejected your application, And if you want to keep the system, you have to come back and sign a new agreement with a payment that is $50 higher per month. If you refuse, they demand you return the system immediately, but they also inform you that they have already sold your old television which you traded in. This sounds like an impossible scenario in any other industry, yet in the world of auto finance, it is a documented reality that targets unsuspecting buyers who believe the myth of the finalized contract. Let us examine a case study involving a character named Jessica, a graphic designer living in a fast-paced urban center in 2026. Jessica has a moderate credit score and is looking for a reliable commuter car. She finds a vehicle she loves, negotiates a price, and sits down with the finance manager on a late Saturday afternoon. The manager tells her that while the banks are technically closed for the weekend, they have a special relationship with several lenders and can spot deliver the car at a competitive 6% interest rate. Jessica is thrilled, signs the mountain of paperwork, transfers her insurance, and drives her new car home. She spends the next 72 hours showing it to her friends, parking it in her driveway, and mentally moving on from the stress of the purchase. On Wednesday afternoon, Jessica receives a frantic call from the dealership. The tone is completely different from the friendly one she experienced on Saturday. The finance manager tells her that the bank did not approve the loan at 6% and that the best they can do now is 10%. They tell her that because she has already put miles on the car and the deal is technically not funded, she must return to the dealership immediately. When Jessica arrives, she is emotionally vulnerable. She has already fallen in love with the car. She has already told her coworkers about it. She is now experiencing a psychological phenomenon known as the endowment effect, where she values the car significantly more now that she possesses it than she did when it was just sitting on the lot. The dealership leverages this emotional attachment and the fear of losing the vehicle to pressure her into signing a second contract. This new contract often includes a higher interest rate, a longer term, or a larger down payment. If Jessica tries to walk away, the dealership might tell her they have already sold her trade-in vehicle, or that she will be charged a massive daily rental fee and a cleaning fee for the time she had the new car. Historically, this tactic is used to extract thousands of additional dollars in interest over the life of the loan from a borrower who was originally promised a much better deal. Potential outcomes of this scenario often include the consumer feeling trapped and ultimately agreeing to a loan that is significantly more expensive than their original budget allowed. To protect yourself from the yo-yo trap, you must understand that the dealership is essentially gambling with your credit in real time. The most effective way to avoid this is to never drive a vehicle off the lot unless you have a signed, stamped, and confirmed approval from the lender, or better yet, as we discussed previously, you bring your own third-party financing from a credit union. If you find yourself in a spot delivery situation, you must be prepared to walk away and return the car the moment they attempt to change the terms. In many jurisdictions, if the dealership cannot find financing at the agreed-upon terms, the entire contract is void, and they must return your trade-in and your down payment in full. However, even if you avoid the yo-yo scam and secure a solid interest rate, there is another layer to the car loan mythos that is far more subtle and affects even the most disciplined buyers. Many Americans believe that if they simply pay off their loan early, they can bypass all the negative effects of high interest and long terms. They think that as long as they throw an extra $50 a month at the principal, they are winning the game. But what if the way your interest is calculated makes that extra $50 almost completely irrelevant? What if the very structure of your interest calculation is designed to ensure the bank gets its profit regardless of how fast you pay? This leads us into the technical depth of simple interest versus precomputed interest, and how a single word in your contract can change the math of your entire financial life. We have dismantled the dealership as a middleman, the myth of the high credit shield, the rollover debt trap, the zero-down illusion, and the finalized contract deception. But as we transition into the next phase of this masterclass, we are going to look at the hidden language of the contracts themselves. Most people look at the monthly payment and the interest rate, but they completely ignore the section labeled method of computation. In Part 7, we are going to reveal why the simple interest loan you think you have might actually be a precomputed interest trap, and we will show you the step-by-step math that proves why some loans are virtually impossible to pay off early without a massive penalty that you never saw coming. This is where we move from surface-level myths to the deep-seated engineering of debt itself. To understand the deep-seated engineering of debt, we must confront the technical reality of how your interest is calculated. Most Americans operate under the assumption that all car loans are created equal, and that if they pay more than the minimum monthly requirement, that extra capital goes directly toward reducing the principal balance. This is the myth of the universal simple interest loan. While simple interest is the standard for most reputable lenders in the United States, there is a far more predatory calculation method lurking in the fine print of subprime and high-interest contracts known as precomputed interest. This distinction is the difference between a loan you can control and a loan that controls you. In a simple interest loan, interest is calculated daily based on the remaining principal balance. If you owe $20,000 at a 10% interest rate, the bank calculates 10% of $20,000, divides it by 365 days, and charges you that specific amount of interest for that day. As you pay down the principal, the daily interest charge shrinks. This creates a potential outcome where an aggressive borrower who pays an extra $100 a month can significantly shorten their loan term and save thousands in interest because they are constantly shrinking the base number the bank uses for its calculation. However, a precomputed interest loan operates on an entirely different mathematical philosophy. In this scenario, the lender calculates the total amount of interest you would owe over the entire life of the loan on the very first day you sign the contract. They then take that total interest amount and add it directly to the principal. Your loan balance is not the price of the car. It is the price of the car plus every single penny of interest for the next 72 months combined into one giant lump sum. This total is then divided by the number of months in your term to create your payment. Because the interest is pre-calculated and front-loaded, paying extra money each month does not reduce the principal you are being charged interest on, because the interest has already been spent in the eyes of the bank. Let us look at a case study involving a consumer named Marcus in the year 2026. Marcus has experienced some financial setbacks and has a credit score in the low 600s. He needs a vehicle for work and visits a dealership that specializes in credit challenges. He signs for a $15,000 used car at an 18% interest rate over 60 months. Marcus is a diligent worker and plans to pay an extra $200 every month to get out of debt faster. If Marcus had a simple interest loan, this strategy would be highly effective. But Marcus unknowingly signed a precomputed interest contract. 3 years into the loan, Marcus has a windfall and decides he wants to pay the car off entirely. He looks at his original $15,000 balance, subtracts all the payments he has made, including his extra $200 a month, and expects to see a payoff amount of perhaps $4,000. Instead, he calls the lender and is shocked to find his payoff amount is nearly $8,000. Because the interest was pre-computed, the bank essentially claims that Marcus owes the full amount of interest for the remaining 2 years of the loan regardless of whether he pays it off today or 2 years from now. In many cases, these contracts utilize a mathematical formula called the rule of 78 to determine how much interest is earned by the lender at any given time. The rule of 78 is a method of weighted interest that ensures the lender receives the vast majority of the total interest in the first few months of the loan. Imagine if you went to a restaurant and ordered a 5-course meal, but the waiter demanded you pay for the entire meal and the tip before you even received the appetizer. If you decided to leave after the second course because you were full, the restaurant would refuse to refund the remaining 3 courses because the transaction was pre-computed. This is exactly what happens to borrowers like Marcus. Even if he pays the loan off early, the rule of 78 ensures the bank has already extracted the maximum possible profit from the beginning of the timeline. This leads to a psychological and financial paralysis. When borrowers realize that their extra payments are not actually saving them money on interest, they often stop making those extra payments and settle into a long-term cycle of debt. They become the ideal source of consistent, high-yield cash flow for the lender. In the United States, several states have moved to restrict or ban the rule of 78 on longer-term loans. But it still persists in many forms of subprime lending and shorter-term contracts. To identify this trap, you must meticulously examine the truth in lending disclosure in your contract. You are looking for a specific section that describes the penalty for early payment. If the contract states that in the event of early payment, you will not receive a refund of the unearned portion of the finance charge, or if it mentions the rule of 78 specifically, you are dealing with a precomputed loan. A safe, simple interest loan will explicitly state that you can pay the loan off at any time without a penalty, and that interest is calculated on the declining balance. But why would a dealership or a lender even offer these types of complex, arguably predatory structures in the first place? It is because the modern automotive industry is no longer about selling cars. It is about selling financial instruments. In the 2026 market, the profit margins on the physical steel and rubber of the vehicle are often razor thin. The real money is made in the interest, the fees, and the secondary market where these loans are bundled together and sold to investors as asset-backed securities. This process is known as securitization, and it is the exact same mechanism that led to the housing crisis of 2008. When you sign that car loan, you aren't just a customer of the dealership, you are a data point in a massive global financial machine. This leads us to a crucial question that most Americans never think to ask. Who actually owns your car loan 3 weeks after you drive off the lot? And more importantly, how does the fact that your loan is likely being traded like a stock affect your ability to get help if you fall on hard times? In Part 8, we are going to pull back the curtain on the world of subprime auto securitization. We will explore how the race to bundle loans into investment products is forcing lenders to approve riskier and riskier deals, creating a bubble that looks suspiciously like the one that popped 20 years ago. We will show you exactly how to find out who truly holds your title, and why that information could be the only thing standing between you and a repossession truck in a volatile economy. To understand why the person who sold you the car is rarely the person who collects your check, we must explore the high-stakes world of automotive asset-backed securities. Most Americans believe that their relationship with the dealership or the initial lender is a static, two-party agreement. They imagine their physical contract sitting in a local filing cabinet. In reality, the 2026 financial market treats your car loan as a liquid commodity. Within weeks of your purchase, your loan is likely bundled with thousands of others, sliced into different risk tranches, and sold to global investors. This process is known as securitization. From the perspective of the lender, the goal is to get your debt off their books as quickly as possible, so they can use that freed-up capital to issue even more loans. This systemic hunger for new debt creates a dangerous incentive structure. Because the original lender knows they will not be holding the risk of your potential default for the next 7 years, they are incentivized to approve loans that might not be mathematically sustainable for the borrower. Historical trends in the subprime sector show that when the demand for these investment products rises, credit standards inevitably fall. This is exactly what happened during the housing crisis of 2008 with mortgages, and in 2026 we are seeing a parallel pattern in the auto industry. Investors are looking for high-yield returns, and high-interest car loans from subprime borrowers provide exactly that. This creates a race to the bottom where dealerships and lenders are pressured to generate volume at any cost, frequently leading to the myths we have already dismantled: the inflated terms, the hidden fees, and the rolled-over negative equity. Let us examine a case study involving a character named Elena, a small business owner in the United States. Elena takes out a $45,000 loan for a delivery van. Her loan is issued by a mid-sized regional finance company. Unbeknownst to Elena, 48 hours after she signs the contract, her loan is sold to a massive investment bank in New York. That bank then packages Elena's loan with 10,000 other loans ranging from prime to deep subprime. They create a security that is sold to pension funds and insurance companies. Now, imagine a potential outcome where Elena's business hits a temporary rough patch in the volatile 2026 economy. She needs to call her lender to request a 1-month payment deferral or a temporary restructuring of her terms. When Elena calls the original finance company, they inform her that they no longer own the loan. They are merely the servicer. The actual owner of the debt is a faceless trust representing hundreds of different investors. The servicer has very little authority to modify the terms because the rules of the securitized trust are rigid and governed by complex legal documents designed to protect the investor's yield, not the borrower's car. Elena finds herself shouting into a void. The person on the other end of the phone is a third-party customer service representative, with no personal connection to her or her community. Because the loan was designed to be a high-yield investment product, rather than a manageable debt for Elena, the system is optimized for repossession rather than rehabilitation. If Elena misses a payment, the automated system triggers a repossession order far faster than a local bank would, because the investors demand their capital be protected. This is the hidden danger of the modern car loan. You are not just borrowing money. You are fueling a global investment machine that thrives on your interest payments but has no mechanism for empathy. If you look at the data from the last decade, the speed of repossessions has increased in direct correlation with the rise of securitization. In many cases, specialized technology like GPS trackers and remote ignition kill switches are pre-installed in vehicles sold to subprime borrowers to ensure that the collateral can be seized the moment the cash flow to the investors is interrupted. Imagine if your house had a digital lock that the bank could activate from 1,000 miles away, the second your mortgage payment was 12 hours late. This is the reality for millions of American drivers in 2026. To protect yourself in this environment, you must determine who actually holds your title and who is servicing your loan. This information is typically found in your monthly statement, but you may need to dig deeper into your original contract to find the name of the originating creditor versus the subsequent assignees. If your loan is sold, you should receive a notice of assignment. Knowing exactly who you owe is critical for two reasons. First, it allows you to verify that your payments are being credited correctly to the principal. Second, it gives you a starting point if you ever need to negotiate. However, the best defense is to never become a desirable data point for the securitization machine in the first place. This means avoiding the high-interest, long-term loans that are most frequently bundled into these risky investment packages. As we look at the broader economy, the sheer volume of these securitized auto loans has created a bubble. As vehicle prices have surged and loan terms have stretched to nearly a decade, the total amount of debt has reached a tipping point. Many analysts are concerned that a minor shift in the unemployment rate could trigger a wave of defaults that would ripple through the financial system. For the individual borrower, this means that the stability of your car loan is tied to the stability of the entire market. If the trust that holds your loan fails or faces a liquidity crisis, your ability to manage your debt could be thrown into chaos. But what if the danger isn't just in who owns your loan, but in how you were convinced to take it in the first place? We have talked about the math, the contracts, and the global investors, but we haven't talked about the person standing right in front of you. We haven't talked about the psychological warfare used in the dealership to make you ignore all the warnings we've discussed today. In Part 9, we are going to expose the actual training manuals used by the elite finance and insurance managers. We will reveal the specific scripts they use to overcome your objections, and the four-square method of negotiation that is designed to confuse even the smartest buyers. You will learn the exact phrases to listen for that signal a trap is being set, and we will give you the counter scripts that can shut down a predatory salesperson in seconds. The math is the weapon, but the psychology is the trigger. We are going to show you how to unpull that trigger before it's too late. To understand the psychological trigger of a car loan, we must enter the highly controlled environment of the dealership finance and insurance office. In the 2026 automotive industry, the most valuable employee is not the one who sells the car on the lot, but the one who sells the money in the back room. These professionals are trained using elite behavioral psychology manuals that focus on a single objective: moving the conversation away from the total price of the vehicle and toward the monthly payment. This is the foundation of the most effective negotiation trap ever devised, commonly known as the four-square method. By dividing a single sheet of paper into 4 quadrants, trade-in value, purchase price, down payment, and monthly payment, the manager can manipulate a single variable to make a deal look attractive while simultaneously hiding massive cost increases in the other 3 squares. Imagine if you were buying a house and the realtor refused to tell you the final cost of the home, instead insisting that you only focus on whether you could afford the weekly utility bill. Most consumers would find that absurd, yet in the dealership, this psychological redirection is executed with surgical precision. When a buyer like Christopher, a project manager in the United States, walks into the office in 2026, he is often physically and mentally exhausted from hours of selecting a vehicle. The finance manager knows that Christopher's cognitive load is at its peak, making him highly susceptible to decision fatigue. The manager starts by asking a seemingly innocent question: what is the maximum monthly budget you are comfortable with? The moment Christopher provides a number, say $700, he has effectively surrendered his negotiating power. The manager now has a target and can use any combination of extended loan terms, high interest rates, and overpriced add-ons to hit that $700 mark, regardless of the actual value being delivered. Historical trends show that dealerships use specific linguistic scripts to bypass your logical defenses. If Christopher objects to a high interest rate, the manager might use the feel felt found technique. They will say, "I understand how you feel about that rate. Many of our best customers felt the same way at first, but what they found was that by taking this rate today, they were able to secure the vehicle they needed and can always look into refinancing potential outcomes in 12 months after proving their payment history on this specific asset." This script is designed to create a false sense of empathy while leading the consumer toward a high-interest contract. The mention of refinancing is particularly deceptive because, as we have discussed, the rapid depreciation of the vehicle and the front-loaded interest of a 72-month loan often make it mathematically impossible to refinance a year later because the borrower will be too far underwater. Another psychological weapon is the assumption clause. The finance manager will not ask if you want the extended warranty or the gap insurance. Instead, they will present 3 different payment packages: silver, gold, and platinum. each of which already includes several of these high-margin products. By framing the choice as which protection package you prefer, they bypass the fundamental question of whether you need the products at all. They utilize the scarcity principle, claiming that these specific rates or protection prices are only available at the exact moment of vehicle delivery and cannot be added later. In reality, most of these products can be purchased independently from third-party providers or insurance companies for a fraction of the cost at any time. To counter these tactics, you must utilize a strategy of radical transparency and silence. The most powerful counterscript when presented with a Foursquare or a monthly payment question is to calmly state, "I am only prepared to discuss the out-the-door price of the vehicle including all taxes and fees. We can discuss the financing once we have agreed on the capital cost." If the manager persists in talking about monthly payments, you must remain silent. In professional negotiation, silence creates a psychological vacuum that the other party will often feel compelled to fill with a concession. Furthermore, you must bring your own calculator or use a specialized auto loan app to verify every number they present in real time. If the math on their screen does not perfectly align with the math on yours, you must ask them to explain the discrepancy down to the cent. Most predatory structures rely on the consumer being too embarrassed or too tired to check the math. Consider a case study where a consumer named Ashley is offered an 84-month loan at 9% interest. The manager tells her the payment is $500. Using a standard amortization formula, Ashley calculates that a $500 payment over 84 months at 9% should support a loan of $31,000. However, the car she is buying is only $26,000. By doing the math herself, Ashley uncovers $5,000 in hidden fees and markups that the manager had simply rolled into the monthly payment, assuming she wouldn't notice the gap. When Ashley points this out, the manager's demeanor often shifts from friendly advisor to cold technician, because the psychological leverage has been neutralized. The ultimate goal of the dealership's psychological game is to make you feel like the process is a series of small, manageable wins, when in reality, it is a single massive loss for your net worth. They want you to leave the dealership focusing on the smell of the new leather and the digital displays, rather than the legally binding document in your glove box that will dictate your financial freedom for the next decade. They rely on the fact that most Americans view a car as an extension of their identity and status, making them willing to overpay for the emotional experience of the purchase. By separating your emotions from the transaction and treating the car as nothing more than a functional tool with a specific price tag, you break the psychological spell they are trying to cast. But even with the best negotiation tactics and a firm grasp of the math, there is one final, overarching myth that holds the entire American automotive economy together. It is the myth that makes people believe they need a new car every few years, regardless of their financial situation. It is the belief that the car you drive is a direct reflection of your success, and that taking on massive debt is just a normal, unavoidable part of adult life in the United States. In our final part, Part 10, we are going to tie everything together. We are going to look at the macroeconomic consequences of these 5 myths and provide you with a master blueprint for a debt-free automotive future. We will show you how to transition from being a victim of the car loan machine to being a master of your own mobility, and we will reveal the one single number you need to know to ensure you never walk into a predatory dealership trap again. The masterclass is almost complete, and the final revelation will change how you look at every vehicle on the road. The final revelation that underpins the entire American automotive economy is the myth of the affordable monthly payment. In 2026, we have reached a point where the average citizen no longer asks how much a car costs, but rather if they can fit the monthly obligation into their existing cash flow. This shift in perspective is the single greatest victory for the automotive finance industry and the single greatest defeat for the American consumer's net worth. When you view a vehicle through the narrow lens of a monthly payment, you are essentially agreeing to lease your lifestyle from a bank. You are choosing to prioritize the appearance of success over the actual accumulation of wealth. To truly master your financial future, you must look at the road differently. Every shiny new sport utility vehicle you see in traffic is not necessarily a sign of a high income. In many cases, based on historical trends, it is a sign of a high debt-to-income ratio and a $30,000 negative equity position. The macroeconomic consequences of this debt cycle are staggering. As we look at data from the mid-2020s, car loan debt has become a primary barrier to homeownership for the younger generation. When a borrower is saddled with an $800 car payment on an 84-month term, their debt-to-income ratio often exceeds the limits required for a conventional mortgage. They are effectively trading a stable, appreciating asset A home. For a rapidly depreciating piece of technology that will be worth half its value in 3 years. This is the opportunity cost that dealerships never discuss in the finance office. If you were to take that same $800 monthly payment and invest it into a diversified index fund, yielding a historical average of 7%, the potential outcomes over a 40-year career are astronomical. We are talking about a difference of over $2 million in retirement savings. By falling for the myth of the affordable payment, the average American is literally financing their way out of a comfortable retirement. To break this cycle, you need a rigorous mathematical blueprint for vehicle acquisition. In the professional financial community, this is often referred to as the April 20th 10 rule, and in the volatile market of 2026, it is more relevant than ever. This rule provides 3 specific guardrails to ensure a vehicle remains a tool for mobility, rather than a weight on your financial neck. First, you must put at least 20% down. This is not just about lowering your payment, it is about creating an immediate equity cushion. As we explored in the depreciation case studies, a new car loses 20% of its value almost instantly. By putting 20% down, you ensure that your loan-to-value ratio stays at or below 100% from day one. You are essentially buying your way out of the negative equity trap before it can ever set. The second digit in the rule is the 4-year term. You should never finance a depreciating asset for longer than 48 months. While the dealership will push for 6, 7, or 8 years to lower the payment, the 4-year limit ensures that your amortization schedule outpaces the vehicle's depreciation curve. It forces you to actually own the asset while it still has significant utility. If you cannot afford the payment on a 4-year term, you cannot afford the car. It is a harsh mathematical reality that strips away the illusions created by the finance manager's 4-square worksheet. The final digit is the 10% cap. Your total automotive costs, including the loan payment, insurance, and estimated maintenance, should never exceed 10% of your gross monthly income. This ensures that you maintain the cash flow necessary to fund your emergency savings, your retirement accounts, and your other life goals. Let us look at a final case study comparing 2 different potential outcomes for a character named Taylor in 2026. Taylor earns $75,000 a year. Scenario A involves Taylor following the social myth. She buys a $50,000 luxury crossover with 0 down on an 84-month term at 8% interest. Her payment is $780. Over the 7-year term, she will pay over $15,000 in interest alone, and for the first 5 years she will be underwater on the loan. If she tries to trade it in year 4, she will likely have to roll $5,000 of negative equity into her next car. In scenario B, Taylor follows the 20/4/10 blueprint. She realizes that to stay under the 10% income cap, her total car cost should be around $625. She decides to buy a high-quality 3-year-old used vehicle for $25,000. She puts $5,000 down, which is 20%. She finances the remaining $20,000 over 48 months at 6%. Her payment is approximately $470. Including insurance, she is well under her 10% cap. 4 years later, Taylor owns the car outright. She has paid only $2,500 in total interest. Most importantly, she now has 0 monthly payments. She can take that $470 every month and put it into a sinking fund. By the time she needs another car in 5 or 6 years, she will have over $30,000 in cash, allowing her to buy her next vehicle without ever stepping into a finance office again. She has officially exited the debt machine. This leads us to the one single number you must know to ensure you never walk into a trap again: the total cost of ownership, or TCO. Most people only look at the sticker price, but the TCO includes depreciation, interest, insurance premiums, fuel, and maintenance over a 5-year period. In 2026, there are dozens of free online tools that calculate the TCO for almost every make and model. When you look at the TCO, you realize that a $20,000 car with a high depreciation rate and high insurance costs can actually be more expensive than a $30,000 car with high resale value and lower maintenance. By focusing on the TCO rather than the monthly payment, you are speaking the language of the wealthy. You are treating your transportation as a business expense to be minimized, rather than a lifestyle statement to be maximized. The mastery of automotive finance requires a fundamental shift in your identity. You must be willing to be the person driving the 5-year-old, paid-off sedan while your neighbor drives the brand-new, 84-month financed SUV. You must find satisfaction in the rising balance of your brokerage account, rather than the features on your dashboard. The 5 myths we have dismantled today: the dealer is a broker, the high credit shield, the rollover illusion, the zero-down trap, and the finalized contract deception, all rely on your desire for immediate gratification and your lack of mathematical vigilance. By applying the April 20th 10 rule, verifying every amortization schedule, and bringing your own financing to the table, you strip the dealership of its ability to exploit you. As we conclude this deep dive masterclass, understand that the automotive industry is currently undergoing a massive transformation. We are seeing the rise of subscription models, the integration of biometric data into lending, and new ways to securitize your daily commute. The traps are becoming more sophisticated, but the underlying math of debt remains the same. You now possess the institutional-grade knowledge required to navigate this landscape safely. You know how to spot the dealer reserve, how to identify precomputed interest, and how to shut down the psychological warfare of the Foursquare method. You are no longer a target. You are an educated participant in the market. However, car loans are just one piece of the puzzle. The same financial institutions that profit from your vehicle are also looking at the next major pillar of American debt: the evolving world of personal lending and the rise of buy now pay later services that are beginning to target even larger consumer purchases. In our next investigation, we are going to look at the hidden architecture of the consumer credit score itself and reveal how the system is being redesigned in 2026 to favor those who stay in debt forever. We will show you the secret metrics lenders use that are never shown to the public, and how you can optimize your profile to gain ultimate leverage over the banking system. Your journey to total financial sovereignty is just beginning.